Welcome to this Killik Explains Finance video. This week, why a shrinking US stock market matters to investors, not just in the US, but all over the world, including the UK. So first of all, is the US stock market really shrinking? Yes, it is. In summary, here's the picture if you like. Yes, stock prices, May 2017, are at or close to all-time highs, not just in the US. The overall value of stocks is therefore rising. Market capitalizations have been on the march. But the number of listed stocks is falling steadily, and that's not just a US phenomenon. And therefore, what you're tending to get is public markets dominated by a smaller number of large firms. So, with that thought in mind, by numbers, if anyone's not convinced, the Wilshire 5000, one of the broadest representations of what's going on in public markets in the US, is now just 3,600 stocks. US listed companies are down from 8,800 in 1997 to 5,300 at the end of 2015. So you can see the sort of size of the shrinkage here in terms of the number of firms. And there have not been fewer listed stocks in the US since 1984. So quite a big trend, quite a long-standing trend, and quite a sizable trend there. Now, why is this happening? Let's look at some factors that have not changed, if you like, and then some that are more recent. So, the laws of the jungle. These are the old, long-standing factors. Yes, companies are always going to disappear from public markets due to a couple of things. Takeovers and mergers. So, very simply put, two firms become one. The value may not change, indeed it may increase, but you've got fewer of them as a result. Then you've got being edged out. Eat or be eaten is the law of the jungle, public markets. In other words, firms sometimes just get too small to remain listed, tumble out of the market as it were, and or they simply go bust, big or small, and that removes them from the public market, from the public eye if you like. Now that's not new. So what is new? Fewer firms are coming to the market. So yes, firms have always disappeared from the market if you like, but why are fewer of them joining the market? Three reasons, and there are more, but three reasons. Fear of regulation and disclosure and media coverage, if you like. So, public companies have to comply with a whole host of complex rules and regulations, make extra disclosures. They're subject to more scrutiny, is the perception, than private companies. And what's more, they get more media attention. And media attention can be a two-edged sword. Fabulous when things are going well, disastrous when they're not. And some firms are simply saying, do I want all that hassle, scrutiny, administration, cost and overhead? Number two, short-termism. There is a perception that in public markets there's pressure to hit every quarter, every 6 months, every year your next target. CEOs only want to hang around 3 to 5 years, then they disappear. That short-termism is thought to exist less strongly in what's called the private market. In other words, where companies stay off-market. They don't become listed, so you and I can't buy shares in them, neither can institutions, for example. And then there's the, do I need to bother? As a result of the way the economy is moving away from capital-intensive industries into technology, firms simply need to raise less capital, goes the argument, and they don't need to tap public markets to do it. And that means what you've got is an army, or what are called private equity firms, broadly speaking, and you've got some monsters out there that are simply not available to the investing public. Some estimates put the number of firms worth more than $1 billion that are not publicly listed at over 100. So you can see what you've got is the rise of this thing called private equity, the rise of private funding alongside the traditional public markets, if you like. Now, why does this matter? Why does this trend, and it is a big trend, it's a definite trend, why does it matter? Well, this is debated, and there are arguments on the other side of the coin, if you like, but this is the story. The oligopolization, easy for me to say, of the economy is one factor. In other words, what's happening here, and it's not a good thing, is that consumers are being faced with less and less and less choice, particularly in certain sectors, technology, social media and so on. Our lives are being dominated by an increasingly small number of massive giants. And if you are a consumer champion, that doesn't look too good. Number two, the exclusion of investors. If you've got a lot of technology companies raising money without coming to the public market, that means you and I can't buy shares in them, and neither can a lot of institutions. And that has a knock-on effect for the way institutions diversify portfolios. Can you, for example, say that a broad index like the FTSE 100 or the S&P 500 represents the US economy if quite a big chunk of it isn't in there? Because it can't be in there. Number three, weaker shareholder democracy. Listed companies, public companies, have to account to their shareholders. Now, those shareholders may not be as active as we'd like them to be sometimes, but nonetheless, they have to hold a meeting, they have to justify dividends, and so on. That kind of disappears when you're off the market, as it were. And finally, less discipline and slower corporate development. There is an argument that says that being in the public eye, being listed, having to jump through those hurdles keeps you keen, keeps you growing, maximises your bang per buck as a company. Being off the market, some of that disappears, some of that momentum disappears. Now you'll find people, particularly run private equity firms, who say that's all nonsense, but then they would say that, or wouldn't they? Okay, lots of facts and figures there, and here's the bottom line. I have been talking about the US market, but there is a cliche, a saying that when the US sneezes, the rest of the world catches a cold. I'm going to finish with a quote from The Economist just recently. The value of listed firms may have risen from 105% of GDP in 1996 to 136% now. If you like, that's the value of companies being almost larger than underlying economies, but a smaller number of bigger firms dominate bourses. And notice, they're not just saying dominate in the US, dominate bourses in general. So this is, to some extent, a global trend that started and most heavily observable in the US. So watch this space. Any questions? Editor@killik.com, and to see related videos, killik.com/learn.